In this class we're going to talk about accounting and look at some of the more basic parts of the accounting system and see the importance of accounting in the management of a business. So it's quite a straightforward introductory class to accounting. Now, a good accounting function is essential in the management of any business. It's important that the managers know what resources are available when making decisions. This will stop them overreaching and perhaps spending too much, or perhaps leaving some resources idle that could be better used somewhere else within the business. So it's important that the managers understand clearly the picture, the financial picture that they're facing within the business, so that they can make more effective decisions. It's also important, of course, that the accounts accurately reflect the performance of the business, so that the managers have a means of measuring their effectiveness, their ability to run the business and to deal with the competitive situation in which they find themselves, the type of market in which they're operating, and they're able to perhaps also benchmark their performance against that of their competitors to see how well they're doing. So good accounting information is essential within the business. The purpose of accounting is to allow businesses to keep track of their money. As I said earlier, if they can't keep track of their resources, their financial resources, they are in a sense out of control. They are going to make bad decisions, they're going to misallocate resources, they're going to focus on the wrong parts of the business. So having good, accurate figures, financial figures, is essential in the effective management of any business. Accounting is all about recording, preparing, and interpreting business transactions. That's what accountants do. They collect information, or rather, I should say, perhaps, they collect data and then process the data into information that can be used by management. So they collect the data, they process it, they prepare it, they interpret it, they explain it. They look at trends and patterns and do analysis and do comparisons. And this enables the management to then take that information, the data has now been converted into information, take that information to help them to make good decisions. The information is then made available to people who need it, such as managers and owners, who then make decisions to improve the performance of the business. And that's what I've been saying. It's important to realize that the information is collected not for its own sake. It's collected so that the managers and the owners of the business can make effective decisions, make good decisions. However, management accounting is used to monitor, plan and control the activities of a business. Now we'll come on to this later on, but just to preempt it to some extent, there are two types of accountancy. There's management accountancy, which is within the business. It's looking at the costs and the processes within the business. And also there is financial accountancy, which looks at the preparation of the final accounts of the business, the profit and loss, the trading, the balance sheet, looks at that type of information, information required perhaps by the tax authorities and the more statutory types of documents that companies need to file. So there's the financial information associated with the business, and also the management accounting, which looks internally, looks at the performance of the organization in terms of budgets, budgetary control, costings, looking at perhaps the cash flow of the business, all to ensure the effective health of the business. So management accountancy allows the business to understand how much profit they have made, and also where the profit was generated, where costs are high, where parts of the organization are not running efficiently. So it's management accountants who are very detailed calculators of costs and revenues and profitability within the organization. So their information is very important to management in making good decisions. They make sure that they have enough to pay the employees' wages. They must have sufficient cash, in fact, to cover all of the obligations of the business in any given time period. And they will also perhaps make recommendations, the accountants in general, as to what dividends can be paid to the shareholders, bearing in mind that the shareholders should receive a good return on their investment. If they receive less, they may wish to dispose of their shares, which will drive down the price of the shares, which may make the business vulnerable to takeover from perhaps a competitor. And of course, the accountants can indicate the possibility of business expansion, whether the resources are available to fund that expansion or not, and where the resources can come from. Now, financial and management accounting, I mentioned earlier, so let's just contrast these. We'll start with, let's say, accounting, and that's our generic heading. Then we have financial accounting flowing off from there. And the financial accountants will prepare statements like, let's say, a cash flow statement. We'll look at the balance sheet. We'll look at the profit and loss and income statement for the business. So financial accounting, the financial performance of a business and targeted at external users, the shareholders, the lenders, the suppliers, customers, and the government. They also may perhaps be targeted at banks and lending institutions. But I mentioned shareholders here in red because they are an important source of funds for many businesses. But clearly it depends on the constitution of the business. If the business is a limited company, it might be a private limited company, in which case there may not be shareholders in the orthodox way of dealing with that term. Private limited companies usually have owners, and the owners might be involved in the business. They're small private limited companies. But large companies will have shareholders, and that's why I just picked it out to emphasize that particular point. On the other side of the accounting diagram here, we've got management accountancy. They look at cost accounting, looking at the costs of the business and how costs vary in the way resources are used within the business. But they also provide information for decision making. So management accounting, well, is intended for internal use of a business in order to make the right decisions. So management accounting helps decision making, whereas financial accounting is aimed at the external users of the information, the banks, the shareholders, the lenders, the suppliers, the customers, the government, the tax authorities. So we have two types, financial accounting and management accounting. Now let's talk a little more about cost accounting and management accounting. Well, cost accounting includes costing as a basis for pricing and stock valuation, planning, control and performance in terms of future costs and how to monitor them using budgeting and standard costing methods. Now we'll talk about standard costing methods in a separate video, and budgeting will be dealt with also in separate videos. But it's important that decisions regarding prices, for example, should be based to some extent on the cost of the business. It would be strange if the prices were set under the costs. If prices were less than costs, less than the average cost of production or the marginal cost of production, then it means that every item produced will produce a loss for the business. So it's important that the management understand the costs and how much the costs are, so that they can then work out what to charge for the product. So cost accountants perform a very important function within the business. But they also price up the stock within the stores, perhaps the stock of raw materials, the stock of semi-completed goods, work in progress. And they're able to put a valuation on the various items of stock, which tells the management whether they're overholding stock or they haven't got enough stock, or which items of stock are moving and which items of stock seem to be stagnant and not moving. So the cost accountants are providing valuable information for decision making within the organization. Now, decision making includes short-term decision making. These include break-even and contribution analysis, and long-term decision making, which is related to strategic management, capital budgeting, and long-term finance. So we have two time periods, short-term and long-term, and decision making occurs in both of these. In the short term, the company will want to make sure that it can pay its bills. It needs to be able to meet its obligations. So it must be able to generate sufficient profits, sufficient reserves to cover its outgoings. So it might look at break-even analysis to see if it can meet its bills and pay its bills over a period of time. In the long term, it might want to look at strategic management and look at capital budgeting to see if it can set up budgets and work within those budgets, and also perhaps negotiate with the banks for long-term finance. So it's the accountants who provide the information and provide the frameworks for the performance of these calculations. Without the accountants, this information would not be available to management, and therefore, of course, management would make perhaps bad decisions, which would be detrimental to the continuance of the business. Cost. Well, cost is the amount of resources, usually measured in monetary terms, sacrificed to achieve a particular objective. Now, costs will be dealt with elsewhere as well, but for the moment, we can envisage two types of costs here. We can envisage the costs of simply the monetary value of the raw materials that's gone in to make the product. But it could include what economists call opportunity cost. What could have happened to those resources had they not been put in to make that particular product? Could those resources have been used more effectively elsewhere? What's the next best alternative to making that product? Could the resources have been used elsewhere to generate an even higher rate of return? Now, accountants are generally in a good position to answer questions like this because they have the skills, the knowledge, the background, the experience to be able to calculate costs and to be able to apportion overheads and apportion fixed costs to particular processes and able to work out what the cost of the product is. And that's important, as I said earlier, that management know what the cost is so that they can work out what the price of the product should be. Without that information, they may get the pricing wrong, which could seriously damage the business. These objectives may be to, let's say, buy a car, to buy a house, or to make a particular product, or to perform a certain service. So sometimes if the resources are gone in to make a product, and the product perhaps is not doing too well in the market, it might have been better to buy a company car or buy a house and invest a house, use that for investment purposes, or do something else with the cash. Don't put it into the product because the product is not going to generate sufficient return. But it's the accountant who works out the return. It's the accountant who will work out what the resources could have been put into to try and generate an even higher return. The aim of a business is to make a product or service that is to attract customer attention. The business is trying to make a product that will attract customers, such as the public or another business. It may be attract individual customers or to attract another business and sell its product to another business. But the aim of the business is to make a product that is attractive to customers, customers amongst the public, or to customers in the form of other companies who want to buy the particular product. But of course, in order to make this product, the company will incur costs, and it's important that the company is able to calculate those costs appropriately. And to do that, they're going to need the skills of accountants, cost accountants. The more people that buy the product or service, the more profit the business will make. Now that's the assumption. The only way that happens is if the accountants know what the costs are, so that the management can pitch the price to generate the profit. Just to simply say that the more people buy the product or service, the more profit the business makes, just simply to say that is not telling the full story. It's important that the business generates the profit because that's why the business exists. But to generate the profit, it must know what its costs are. And that will enable it to set a price. And if the price is competitive in the market and the product is desirable, then it should sell the product, generate a profit that way. But the information necessary to work out what the costs of the product are, the full cost, including the overheads which are assigned to the product and the variable costs of the labor, the energy, the raw materials, all of those must be calculated by the accountant and then given to the management, who will work out the price, and hopefully that will enable them to generate the profit. It's important for any business to control its costs and increase profit. That's why the businesses exist. The businesses exist to make a profit. They don't just exist for the fun of it. By and large, they exist to make a profit, and in order to do that, they must have the information necessary, as I said earlier, to make good decisions. Now, the classification of costs. Well, the main costs in a business include material costs, the costs of obtaining the materials and receiving them within the organization. The cost of having the materials brought to the organization is known as carriage inwards. So organizations may have to buy in raw materials, buy in components, and they have to be shipped in, they have to be brought in. So there's not just the cost of buying the products from perhaps a supplier, but also moving the products from the supplier to the business, which is known as carriage inwards. There's also labour costs, and this means that the company must pay wages and salaries, together with other employment costs associated with, let's say, issues like health and safety, safety equipment, training programs for the workers. So there are different aspects of costs associated with labour, and they must be worked out carefully and paid for. Expense and overhead costs. Well, these are external costs such as rent, business rates, electricity, gas, postage, telephones, and office consumables, office facilities, transport, all sorts of costs that go to make up the product need to be accounted for, need to be itemized and accounted for. And for those reasons, a good cost accountant is invaluable within the business. The cost accountant is able to work out what those costs are, and from there perhaps able to work out the cost of the product, of making the product, and from there again feeding that to management. It will enable them to set the price, which will generate a profit. So accountancy is of critical importance. Good, accurate information, contemporary information in the sense of being up to date, is important within the business, so that the management can make good decisions. And that's why accountancy is so important. So that's all we're going to deal with in this talk. As I said, it's a very simple, straightforward introductory talk into the importance and the nature of accountancy, and the two types, financial and management accountancy, and why management accountancy is so important in terms of the provision of information for good decision making. Having said that, let's leave it at that and say thank you for watching.